Elliot Clarke, Director and Senior Economist, has been a member of the Westpac economics team since 2010. He is responsible for managing Westpac's international economics forecasts, including those for the US, Europe and China, undertakes regular macro financial research on the Australian economy, and is regular spokesperson for Westpac on the domestic and international economy. Prior to joining Westpac, Elliot spent 4 years with the Reserve Bank of Australia in a number of positions, assessing economic conditions in the East Asian region, as well as developments in global financial markets and international capital flows. Elliot holds an honours degree in economics from the University of Sydney, a Master's in Applied Finance from Macquarie University, and is a CFA Chartered holder and a member of the CFA Society of Sydney. Please welcome Elliot to the stage as he discusses the theme for the month, budget and finance. Thank you.
It's very nice to be back in Castle Hill with you all again for another year. I think it's fair to say in the global economy there's always lots to talk about, but in 2016 it seems like there's even more than would normally be the case. We've had quite a volatile start to the year with a number of key themes sort of working their way through the world. We've had sort of concerns around negative interest rates and the changes that we're seeing in alternative policy measures around the world, and particularly in Europe, and that's kind of filtered out to the global economy. And at the same time, we've also had a lot of anxieties around emerging markets. So we've had Russia and Brazil in quite significant sort of recessionary conditions associated with weak oil prices and also the weak iron ore price. At the same time, that's also flowed on to additional concerns around other sort of emerging markets, and most notably there has been China, where we continue to see growth slow, albeit still remain quite at a robust level, and we're looking for about a 6.5% growth rate this year. And now, in part of all of that, and we'll talk a lot more about the sort of the global situation in a second, we've obviously now had the budget with a lot of different sort of, I guess, parameters and sort of thoughts and policies to think about, which we'll go through in detail as we move through the presentation. And obviously now we're setting up for the election in Australia in July, and we have the US election in November as well, and we now know that presidential nominee Trump has been, I guess, almost confirmed, so that'll make things interesting for the rest of the year. And in addition to that, we have a new RBA governor as well to think about later in the year and what the potential implications are there. So lots to think about, and what we're going to do today is really start global, come back to the budget, and then also consider some key themes we're seeing in the Australian economy. So just to start with, it's always useful to take, a broad view and just assess how sort of global growth conditions are around the world. As I mentioned, we have seen Chinese growth continue to slow, and we're looking for about a 6.5% growth pace this year, and slowing again to 6.2% next year. What's really important to note about China at the moment is that the economy has grown so much. The growth rates around that sort of 6% currently are equivalent in terms of the total dollar amount of activity as sort of growth rates in the sort of 10 to 15% range were sort of 5 to 10 years ago. So there's still a significant amount of momentum coming from the Chinese economy, and it's flowing through and providing a significant support for the Australian economy. At the same time, we're also seeing in the US and Europe, around about trend growth. There hasn't been, that sort of acceleration in growth that they would have wanted to see, particularly in the US, where you're starting to see rates rise. Obviously, at that kind of time when you start to raise rates, normally you're sort of seeing the recovery really take hold, and you're getting above trend growth, and there's strong justification both in terms of jobs and also inflation to raise rates. That's not really the case at the moment, and that's really being why you haven't seen the Fed continue on with rate hikes this year after that first rate hike last year. They're really trying to focus in and assess what's happening in terms of the US dollar, what that means for investment and job creation in the US economy, and really take their time to actually normalise rates. We had been expecting 2 rate hikes in the US this year. We've now pulled that back to 1, and are expecting a further 2 next year. Now, if that is accurate, and we do come through and see that kind of transition to a sort of a rate around about 1 or 1.25%, that's really going to be by far and away the historically weakest, rate hike cycle we have seen for the US economy, and indeed sort of more broadly across the world, and basically forever. And really emphasises the degree of uncertainty around the global economy, and also the difficulty in actually getting back from that lower bound of policy. Obviously that has implications for the Australian dollar, and we'll discuss those a little bit more in a second. What this kind of means in terms of this having this, sort of global growth is kind of remaining about trend or a little bit lower, sort of those low threes, is that for Australia, we're not getting that same kind of momentum and drive in terms of investment in mining, obviously. And at the same time, there's not necessarily that same sort of really robust activity that's leading to more broadly to support our exports. And so we're looking for Australian growth to remain about trend this year and next, which obviously keeps the RBA in play, as we have seen over the last week or so. If we just sort of think about two sort of key themes in terms of linking the global economy to Australia, those really are the terms of trade, so our export prices relative to our import prices, and also the Australian dollar. So with regards to the terms of trade, obviously we have seen a significant deterioration in the income we receive from our commodity exports. So not necessarily sort of, because we're seeing a significant increase in volume still, we're still getting quite a significant income stream coming in, but it's not anywhere near what we had expected as we started to have this mining investment boom 5 to 10 years ago. Obviously, we've had quite a significant increase in supply, and that's weighed on prices as well. So that combination of soft global demand and increased supply is leading to persistent weakness in both the iron ore price and also the oil price as well. With regards to Australia, we're not an oil exporter, we are an energy exporter though, so that oil price still matters a great deal to our terms of trade and the income that comes into the country. Now, what this means for the economy overall is that we're unlikely to see a significant increase in mining investment for the foreseeable future. In addition, as I mentioned, sort of incomes are weaker than have been expected, and that impacts the budget bottom line as well, because they're not getting that same kind of level of royalties, both at the state and also the national level. The positive, however, has been the Australian dollar. So obviously coming down and sort of being in that sort of 70s area has really been a significant improvement into our competitiveness. It really helps the new sort of, I guess, growth engine of the Australian economy, which we're looking to, which is services exports. And again, we'll sort of detail this a little bit more later, but if you think about education and tourism, as well as business services and the greater linkages we're seeing into Asia, all these areas lead to quite strong demand for our services as we think about trying to do business more so with Asia than we have done in the past. And on the other side of that, the continued development of the middle class and sort of the rising wealth we are seeing in those regions really support that from a demand base as well. So that then brings us to the budget. Now, obviously, we're about a week after the budget now, and a lot of the detail is known. So I'll go through, I guess, the highlights quickly, and then we'll sort of think about sort of what, I guess, is underlying those forecasts and sort of how credible they are, I suppose. So at the moment, the way the government is projecting the deficit, we have seen a bit of a deterioration in the current year, and also is expected for the 2016-17 year, or the coming year. So we've got a $40 billion deficit for 15-16, and that should improve slightly to about a $37 billion deficit in 16-17. The storylines behind these deficits is really quite different. So the 15-16 number has been associated with a weaker than expected revenue income, or revenue contributions, which are associated with non-mining sector wages, as well as superannuation having slightly lower sort of tax take than had been expected. Where 2016-17 is really all about the election. So looking forward, thinking about sort of trying to, I guess, procure votes and get people to be confident in the government as we move into the election. And so we're seeing there particularly the tax, also the increase in the threshold for the 37-cent tax threshold to $87,000 is really a key factor behind that sort of deterioration in the 2016-17 year. As we move forward over the projection years, which are about 4 or so years to 2019-20, you can see that the government remains quite confident they will likely see a significant improvement in the deficit. This is really primarily due to stronger revenue growth, which comes from general aggregate economic growth, as well as in addition to that savings. So to balance the two out, you're looking at about 1.6 percentage points improvement is associated with the improvement of revenue, and then 0.6 percentage points associated with actual savings that are generally sort of backloaded into the out years. And so you see as you move through the forecast horizon that the improvement accelerates quite significantly. Now, as I mentioned, we're talking about sort of the credibility of these forecasts, and there's kind of a number of elements to that. But the most important one really is nominal growth, and so that impacts wages and also sort of helps because it's the denominator in this kind of equation here, taking us back down to having a deficit close to zero. So The focus here really is nominal wages, and as I mentioned, with regards to the iron ore price is quite key. So the forecast is actually for iron ore price to remain at $55 a tonne through the foreseeable future, and that gives a significant sort of windfall to the budget. We have seen in the last week or so that become under quite significant tension. So we have seen substantial slippage in terms of the iron ore price over the last week or so, and it's going to be that really emphasises the risks that are actually to the budget. If you don't see that sort of persistent sort of income stream coming through the budget and impacting sort of household wages in terms of dividends and also the wages they get from working in the sector, then you're likely to see a weaker budget across the out years. In addition to that, as I mentioned, all the savings are generally backloaded into the budget. So they're looking for savings out in 2018 and 2019. And so as you push those kind of savings out to a few years, you're more likely to see, I guess, a volatility in those numbers and potentially weaker than expected outcomes there. So in terms of the key savings measures, there's a few here that are perennial givers. Cigarettes is the number one. So that's obviously a way in which the government can continue to actually get a significant improvement in the bottom line, is to basically continue to increase the tax take about 12.5% each year, and they're doing so for the next 4 years. In total, that's looking like it'll provide about $5 billion to the bottom line. The multinationals initiative is interesting, and it's one I guess I have reservations about, mainly because of the time. So you would expect the number that they've come from, or they've created here, is really probably a fraction of what is potentially likely to be able to be taken. But at the same time, it's going to take quite a long time. They're looking to hire 1,000 people at the ATO to go and actually assess and potentially litigate people who are found, whether they're multinational businesses or high net worth individuals, who have been found to actually be, I guess, skirting the tax arrangements. And so that all takes time, and it maybe leads to potentially only receiving a portion of what is actually expected to come through, or what they have actually managed to get as benefit from the tax system. So that 3.1 billion figure there is really about this task force that's being created, and that's going to be, I guess, an initiative over the next 4 or 5 years to actually see whether that can actually be brought through. If we look to the other measure, which is not actually included in that number, which is the, I guess, what they're called colloquially the Google tax, which has become more popular in the UK as well. And this is basically looking to actually add an additional amount of taxation to multinationals who have been found to actually breach their requirements. So instead of paying 30 cents on the dollar, they'll pay 40 cents on the dollar. The other initiatives there are really sort of around efficiency, although I should actually note superannuation as well. So this has been quite a key talking point so far over the last kind of week or so. I even noted on the taxi on the way here, it's still being talked about a lot. The main focus here around superannuation is whether this is kind of retrospective or not. I'd probably argue it's not actually retrospective, but it does actually change the potential income streams that people are likely to have, or high net worth individuals are likely to get from superannuation. So the kind of key major initiatives here are firstly is the $1.6 million cap on what can be included in a pension account. If people have more than that when they retire, they have to leave that in an accumulation account and therefore pay 15 cents on the dollar tax on that, rather than the zero current arrangement. The Labor policy, which was announced by Shorten in his reply after the budget, although it's different in structure, actually leads to very similar results. So they're looking to basically tax, again at 15 cents on the dollar, any income earned from superannuation over $75,000 a year. So if you take the 1.6 million, you say, okay, we'll get 5% from that, you're getting to about $80,000. So it's quite similar in terms of the bottom line of the budget, albeit quite a different structure. The other major, I guess, initiative on the savings side is around sort of putting in this $500,000 lifetime non-concessional cap. That's a significant change from the $180,000 that has been allowed before now. And I have, in sort of discussions I've had with accountants while doing presentations like this, it sounds like there has been a significant amount of, I guess, front loading and people trying to push into those additional contributions in before that sort of new initiative took hold. And this is the only initiative that actually theoretically started effectively now, rather than 1 July 2017, which is when all the other initiatives are coming through. The other sort of, I guess, more marginal elements of the savings package are reducing the concessional cap down to $25,000, irrespective of age. So previously, people who are over 50 could add 35 rather than 30. So everyone can now only provide $25,000. And in addition to that, also reducing down the threshold at which you start paying 30 cents on the dollar rather than 15 cents on contribution. So that will now be $250,000 rather than $300,000. Now, again, that's a point of consistency across both parties. Labor is in agreement with that being sort of the case as well going forward. As I mentioned, the rest of those savings initiatives really are efficiency dividends, particularly the public service is looking to basically rationalise the workforce and reduce costs there. Again, this is one of the perennial givers. They always look to this to provide $1 to $2 billion each year. And then the other initiatives there, the workforce in particular, that's, although it is a savings measure, the funds are going straight back into new spendings initiatives as well, which again, sort of retargeting and reprioritising sort of around youth and trying to get them more into work and think about ways to give them on-the-job experience. So with regards to the spending measures, again, efficiency is really quite a key word here. So health and education, the focus there is using this money to actually provide, programs and sort of task-oriented initiatives which look to actually reduce the costs and improve the cost-benefit ratio for health and education. Both of those initiatives are also backloaded, so we're talking about 2018 onwards. This is quite a point of difference between Labor and Liberal in the sense that the Labor Party is looking to try and bring through all the Gonski reforms, and in doing so, that's a significant amount of spending which would actually go through into the education sector. Whereas, as I mentioned, for the Liberals, it's more about trying to get the states to actually take a tighter look at their budgets and be more efficient with what the revenue they do have. With regards to defence, it is not really a major initiative. All of the sort of white paper additional sort of spending that you have heard a lot about, the submarines, the frigates, all of which is going to be produced in South Australia, that's coming in sort of 2020 and on, so it's not part of this budget. In terms of, the other sort of key things are on this graph, obviously, I mentioned it already, the personal tax changes, so moving that threshold to $87,000 for the 37 cent bracket. And that's basically that whole $4 billion. There's not really any other changes there. The small business tax area is, again, another major area where there is a difference. So, as I mentioned, so the Labor, if they get into government, would look to provide a lot more money to education, and that would come at the expense of allowing larger businesses to actually get the tax relief that small businesses are getting currently. So that's kind of a real point of difference. And there's, depending on how you want to think about what's really driving the economy, education obviously is going to provide, education primary and sort of secondary levels of schools are going to provide a significant benefit for the economy sort of in the distant future, whereas small business tax cuts and expanding that out to sort of medium-sized and then large businesses out to the 2020s is going to potentially give you a greater incentive to actually have increased investment and potentially increased employment as well. So it's that kind of, playing off of the sort of medium-term prospects versus the long, and what's the kind of preference of the population. Again, superannuation comes up here as another sort of key category. And in terms of spending here, it's about allowing, more flexibility in the workforce. So if you stay out of the workforce for a couple of years, whether it's to look after kids or you take a career break, you will then be able to use the concessional contributions caps that you could have used in those years in later years and catch up on your superannuation. The government's also looking to extend, albeit by a different name, the $500 rebate that people currently get for superannuation tax if they are paid $37,000 or less. So that's again giving a little bit more momentum to the lower income threshold cohorts and providing them with a little bit more flexibility and support in terms of trying to save for their superannuation as well. The infrastructure number there, just as a final initiative on the spending side, that's not really new money. This is really about the asset recycling program. So this is the idea that the federal government will provide additional contributions to the states as they sell assets and actually look to reinvest those proceeds in new assets and new infrastructure. So it's a ability, to give more flexibility to the states in actually creating that sort of momentum and getting sort of greater infrastructure built, but it's not actually sort of new money. The only real new money was about $100 million to provide to assess the Badgerys Creek Airport as we move forward into thinking about planning that project. And also there's about $500 million which is actually given in the current year to Perth to finish off a rail link. So what does all this mean for the Australian economy? Well, at the moment, I think, as I gave you a very similar slide last year, which really emphasised where we were at in the cycle. So we are in the middle of the mining investment downswing, albeit the contribution or the drag that it's having on growth aggregate is actually starting to abate. And so we're going to see less and less of a drag on growth as we move forward in the next couple of years. At the same time, the net exports contribution is coming from that increase in supply, whether it be iron ore and now LNG, is providing that contribution in terms of net exports. And as I mentioned here, services exports are becoming an increasingly important part of that net exports line as well. And you kind of see both of those two categories kind of net out with one another. And so it really emphasises that the consumer and also business investment are really kind of the key factors in creating and determining the level of growth we're getting in the economy. Our expectation currently is that the consumer will remain quite robust, and that obviously gives you a significant support in getting us towards trend growth. At the same time, at the margin, you'll get a little bit of support from business investment, but it's not particularly strong, and there are significant risks around business investment at the moment. The other thing that's not noted, I guess, in this graph is public spending. Now, here there's quite a diversity of views and sort of experiences around the nation. Sydney and Melbourne are doing very well. They're getting a lot of money invested in terms of infrastructure, so the North West Rail Link and sort of other key roads and sort of the development of those kind of corridors across the major metro areas. That's really providing a significant dividend for the Sydney market as well as Melbourne. And you really see that in an area such as Castle Hill, which is becoming much more interconnected with not only the Sydney CBD, but also Parramatta and Chatswood and those kind of areas. And it means that people have more flexibility in where they live and where they travel for work. And obviously it sees a significant amount of development in areas such as this as new apartments are built and the housing stock changes quite a bit. And so that's quite a point of difference regards to versus, I guess, Queensland or WA, which just don't have that public investment at the moment and are unlikely to see that going forward because of the budget reality that they're facing in those states. House prices are always, a point of interest for these presentations, and I won't disappoint this time. I'll talk about them. So we have seen a significant slowdown in terms of the momentum we have seen in the housing market, and this is partly, a function of increased supply that's starting to come online, but that's for Sydney, that's more of a 2017 story. What it also is the impact of the APRA reforms in terms of trying to rein in investor spending, and more recently as well, a tighter requirements being imposed on foreign buyers as well. All of that is leading to a much more, a more balanced market with owner-occupiers and upgraders really looking now to step in and take their opportunity as opposed to the investors being really the only game in town. We have seen, obviously, the momentum come right out of the Sydney price market, but in most recent two estimates, both the weekly data we get now to give us an estimate on what's happening in May as well as April, there has been momentum come back, and obviously now with the rate cut, which we saw last week, there's evidence to believe that that'll likely give a bit more support. We don't think we're going back to sort of 10% plus appreciation. Affordability is an issue, and that is likely to keep a lid on sort of momentum we are seeing in sort of house prices. So think more sort of 3 to 5% growth range, which is consistent with income growth as opposed to a multiple of income growth. You'll also note there that while Melbourne and Brisbane are seeing, again, continued sort of modest price growth, Perth has improved back to kind of zero mark, but we're starting now to see more of a second wave of weakness, sort of job shedding and sort of softer consumption activity in WA. So it's likely we will see further weakness in prices in Perth. In terms of, the momentum we're getting in the economy from the housing market, that's likely to continue, but it's not going to be contributing to growth as much going forward. So we see a plateauing of the pipeline and sort of dwelling activity continuing on for the next year or so as those projects are built and come to market, but not necessarily further growth because there's only a limit. There is a limit to the amount of projects that can be done in one particular time, and we're really probably at that threshold now. And that's not the way that's meant to look. Okay, so I think the way to just think about this is the dotted lines. So those two dotted lines really just emphasise that consumption growth has been significantly slower in the post-GFC environment than the pre-GFC environment. This has been, a bit of a puzzle for economists as to why this has happened. And we have seen confidence remain relatively robust and albeit fluctuating around average levels. And that's normally a time when you see quite robust or rapid growth in consumption. There seems to be two sort of key factors as to why this has been the case. So one is that I guess households have been looking to think about investing as opposed to consuming. So that you can see this in the housing market where a lot of people have been looking to buy an investment property and think about their long-term wealth as opposed to their actual current consumption. And the other side of things is really just kind of their sort of wealth income balance. And this is kind of where I just want to focus on for the next little while. So wages growth has slowed quite considerably despite the significant amount of jobs that are being created. So we have an unemployment rate of 5.7% at the moment, and we have seen sort of jobs growth maintaining quite a robust pace, well above kind of the population growth in the moment. And it's been that kind of, I guess, difference we're seeing in wages versus the jobs growth has been quite an interesting trend to note. What it really seems to be is that it's not just about sort of the mining sector and the impact that's having, but it's also this kind of broader push to I guess rein in wage costs across the economy, and that's really likely to stay in place. We don't think it's going to necessarily fall sort of down to the ones, but we're not likely to see sort of wages growth accelerating back to 3% anytime soon. So that's kind of going to be a continual sort of negative influence, I suppose, for the economy in terms of not getting that sort of above trend growth in consumption. The other thing to note, we lost the graph as well. Okay. The other thing to note, which should be in there, was around sort of what's been happening with terms of household leverage. So that is at a significant high level, and we've seen a lot of households look to actually basically continue to save deposits and improve their wealth rather than actually go out and spend money. So again, that sort of, I guess, a confidence in the future and a belief that their wealth is going to continue to improve will allow for a greater support for the economy going forward. The other thing just to note with regards to business investment, obviously, is that we haven't really seen that push through. So businesses are willing to hire, but not necessarily actually expand capacity. And until we see greater confidence there push through and the support that we need to see, then that's likely to remain the case. I'm just going to jump to the RBA. I've got a problem. Okay. Just quickly on the RBA before we finish up. So the focus there, obviously, we have seen a rate cut last week, and we're expecting another one in August. And the basic line of that is that the weakness we've seen in inflation has meant, or given them capacity to act, and they're looking to try and stoke demand and get growth above trend. From 1.5%, there's not really a lot of capacity to actually go out and provide further accommodation, and it's it's a question as to whether that really actually pass through easily into prices as well. So we are really getting to a point now where we need to see rates remain low for a long time and allow the economy to actually get the momentum that it needs to see and develop it itself. So that's going to be really focused as to how inflation develops over the next kind of year or so, and also sort of whether we do get sort of greater momentum coming through in jobs and consumption that's going to allow that sort of economy to heal and then think about potentially seeing an upcycle come 2018. So I think just to allow a little bit of time for questions, I'll finish off there, but very happy to take questions. And the microphone's around.
Hi, Elliot. Thanks for your presentation. Very informative. You talked about the shift from resources to services, which is a big topic, particularly at this time with the election coming up. Mm-hmm. And then you mentioned the $8 was a big impact on the growth in exports, including services. What's the challenge around investment? Your investment slide was showing that the investment in services is going to be pretty low over the next few years. Mm-hmm. What else can be done to stimulate the growth in services to offset that downturn in resources?
I think it's the trend we are seeing in services is very, very significant. So we kind of jumped over this, but you're seeing broad-based support across all the different services sectors. And so it kind of feels like it's undertaking its own process, that there is this pipeline building, and it's really associated with the growing wealth we're seeing in Asia, and that's coming through. So a weaker dollar would definitely help give further support. So to the extent we're calling down to the low 70s, if we got sort of 65 or something like that, that would be fantastic in terms of helping the economy. But it really is a matter of continuing to develop the linkages between Australia and Asia, really encouraging sort of the Asian region to come and do business here. That's really going to provide that additional momentum. And in terms of how that plays through into investment, I think it's just a matter of time. We're starting to see more building projects around hotels in the major capital cities. And so the longer that people start to experience this as being a new sort of long-lasting trend, the more likely they are to go and invest and develop that capacity. So yeah, time and the Australian dollar and sort of our brand to Asia are kind of the three key things. Got another question?
Thanks, Elliot. Phil Diversity from Diversity Consulting Engineers. Interested in the housing and construction approvals. I'm wondering where you see that heading in the next few years and the trends, I guess, for that.
Yeah, sure. So as I kind of mentioned before, there's a kind of limit in terms of the amount of supply you can bring on at any one time, and we're running at a well above historic average finally. It's been a long time coming, but we are there now. So we don't necessarily think there's going to be a lot more growth in terms of developing the pipeline, but in terms of the level of activity, we think that's likely to kind of plateau out and remain at a kind of constant level. So the amount of activity that's going on now persists, but it doesn't contribute to growth going forward. We would expect that pipeline to be replenished as we move through and that supply is taken up, and there's once you see if developers can kind of see that supply has been taken up and there's reason to actually go and invest in new sites going forward and see a significant continued contribution to activity from the sector. It is fair to say that we have had undersupply, I suppose, in the market, particularly in Sydney and Melbourne, for a long period of time. So there's justification in saying that this kind of high level of activity continues on for a protracted period. So that's kind of the basic view we've got.
Thanks, Ian. I'm just thinking about a challenge that we seem to face. Growth is what we're looking for. Where does our current immigration and future immigration plans fit in? I grew up in an early age where all the immigration was from people who came out and worked hard and paid taxes. Now we seem to have an immigration system where we have a lot of people coming out that don't actually contribute a lot but actually drain a lot. What effect will this have on future budgets and in our businesses? It's a sensitive topic, I understand, but I had to put it in.
I think you are starting to see some changes being made in terms of the significant visa program. They're trying to shift people into actually investing in businesses rather than investing in sort of housing or bonds or something like that, which are not necessarily going to actually lead to any sort of active growth in the economy. So that is one sort of step in the right direction. I understand where you're coming from in terms of saying that there's a very different sort of structure going on there. I think the way, if we can try and push more into that and really get people to actually look to actually invest into businesses and be an active part of those businesses and to create jobs going forward, that's really the way forward. I think it's likely to take a little bit of time in terms of actually developing those initiatives, however, so I wouldn't expect it to change overnight. But I think in general there's a broader hope that I have, which is that we can think about being a little bit more entrepreneurial across the economy, and trying to more actively engage with the Asian region as well in terms of actually developing new businesses. So you're seeing it more at the bigger businesses, or like large law firms and things like that have created strong relationships across. But there's initiatives whether it be through the various chambers, business chambers around Sydney and those kind of things, where people can actually sort of link into other sort of regions and do business that way, and that would actually provide both an avenue for funding to come back as well as just kind of a ability to expand business overall as well. So that's my hope for the future, I suppose.